You've probably heard me say before, I'm not team annuity and I'm not team never annuity. Naturally, the next question I get is, okay, Zach, you're neutral, but when do you actually tell someone to buy an annuity and when do you say absolutely not? In this video, I'm going to walk you through my real checklist, the questions I ask before I ever recommend an annuity, and the types of people where it can make a lot of sense. And then we'll talk about the types of people where I almost never use an annuity. Further, I'll talk about how much or what percentage of a portfolio that might go into an annuity based on some example case studies. I'm Zach Poitra, a fiduciary advisor based in Colorado Springs, and I work with people 50 years or older who want to maximize their retirement income and minimize taxes through a clear and cohesive plan. Before we even talk about products, I want to run through a quick annuity fit test. Here are the big questions. There's the what I call sleep at night risk analysis. The question is do you lose sleep when the market drops 10 or 20%? Got to be honest. If a bad year makes you want to sell everything, that tells me that you might need more stability baked into your plan. Then there's the income gap analysis. How big is the gap between your guaranteed income, like Social Security and maybe a pension, and the lifestyle that you actually want to have during retirement? If that gap is small, then we might not need any annuity at all. If the gap is large and the margin for error is thin, a guaranteed or stable income piece can make all the difference in the world. Then we got to look at longevity risk. Do you have a family history of people living in their late 80s or 90s or even beyond that? If so, then we're looking at planning for a 30-year retirement or even longer. And outliving your money, that becomes a real risk if we're looking out that far. And a lifetime or strong income floor, that starts to look more attractive in those situations. Then there's health and the level of flexibility that you want. Are there health issues that might shorten your life, or do you value maximum flexibility and control with your money? If your time horizon is uncertain due to health issues, you might want to stay ultra flexible. And we may lean more towards liquid investments like stocks and bonds and less towards the long surrender schedules associated with annuities. Now, those four questions usually tell me whether we should even start exploring an annuity or whether we can likely get you happily through retirement with dividend income and a traditional portfolio alone. Now let's talk about when I commonly do use a fixed index annuity. And there are three profiles where I often consider carving out a slice of a portfolio into a fixed or fixed index annuity, and I break it down into these different profiles. First, we have the worried spender. This is a person who has saved very well, but is scared to actually spend. They're constantly checking the market every day, and they're always asking, what if 2008 will happen again? For them, carving out a portion into an annuity to cover essential expenses, that can really give them the emotional permission to actually enjoy their retirement. Then there's what I call the late saver. This is a person who in their late 50s or early 60s waited until then to start seriously saving for later in life. They might not have enough cushion to comfortably ride out a really bad decade in the market. And in this case, an annuity can kind of act like a shock absorber. It doesn't have to be everything, but it can protect the bare minimum income that they can't afford to lose. And then finally, there's the single person that doesn't have a pension. If you're single with no pension and Social Security is your only guaranteed income, then all the risk is on your portfolio. And in this case, using an annuity to create a more predictable paycheck can really take the pressure off the investment side and help manage longevity risk. In all of these cases, we're not chasing bells and whistles. We're using an annuity as a simple safety net inside a bigger plan. Now let's talk about the flip side. Here are three profiles where I rarely recommend annuities. First, there's the overfunded retiree. If you have way more assets than you need relative to your spending and you're comfortable with some volatility, you probably don't need to trade away liquidity and upside for guarantees. Then there's the person who is super flexible and market comfortable. If you understand market risk and you lived through multiple cycles and you're okay seeing your balances move around as long as the plan is sound, we can usually do just fine with dividend income and traditional investments. And lastly, we have the person with a high risk tolerance and a long time horizon. If you're still working or your retirement income needs are far off into the future and you have a genuine high risk tolerance, locking money into a long-term annuity contract is often not the best use of those dollars. Again, this is not about good or bad products. It's about matching the tools to the right person and the right plan. Now let's talk more specifically about where annuities can fit. In my practice, I think of annuities as living in the same bucket as bonds. They're both in the safe and stability side of the portfolio, but there are some differences, and here are the key differences. Bonds can go down in price when interest rates rise or when credit spreads widen. With fixed or fixed index annuities, the account value doesn't show daily price drops the way bonds do. So you're trading market price movement for the contract rules. Because of that, for some clients, we'll use a fixed or fixed index annuity to replace part of what bonds would normally do in their plan. In terms of allocation, I rarely want annuities to dominate the entire picture. For most people where it fits, I'm usually looking at something in the range of up to around 40 to a maximum of 50% of the overall portfolio in that bond/annuity safety bucket. Then we would have the rest in dividend growth stocks or other investments for income growth and long-term appreciation. I want to be clear that the 40% is the maximum, not the target for everyone. Some people use less, some people use none. The point is, it's a slice, not the whole pie. Now, the most important thing I want you to take from this video is simple. Product last, plan first. We start with what are your spending needs? And then we look at what income you already have coming in and how long we need to make your money last. And then finally, how much risk can you actually live with? With that information, we decide how much belongs in dividend income strategies or traditional stock and bond investments. Then we look at the possibility of a fixed or fixed index annuity as a safety net. It's always important to remember that an annuity is just one tool in the larger toolbox. Now, if you've been watching this and thinking, okay, I hear you, but I still don't know which side of that line I'm on. And that's exactly what I help people figure out. If you'd like, we can run your numbers through this exact checklist, look at your income gap, your risk tolerance, and your longevity picture and see in black and white whether an annuity has a role in your plan. Or maybe you're just better off sticking with dividend income and traditional investments. If that would give you some peace of mind, you can find a link in the description below this video and you can schedule a time to talk. If you're not ready yet to chat, you might like to check out my free retirement masterclass, to which you'll also find in the description below. There'll be a link down there. And again, it's a free masterclass. Either way, don't let slogans or fear-based ads make this decision for you. Get the facts, understand the trade-offs, and then choose what actually fits your life. If you like this content and want to receive more like it, please like and subscribe. Now, this video is for informational and educational purposes only. This is not financial advice, this is not tax advice, and any guarantees mentioned in the video, they're based on the claims paying ability of the insurance company. Talk to a licensed professional, such as myself, before making any investment decisions.